Hi friends, have a look at my screen and what you will note is that since January 2025, money supply into large cap space has come down drastically. For example, in January 2025, 3,000 crore were injected into large cap companies. It has come down to 1250 crores by May 2025, almost 60% reduction in the money supply into large cap space. Now, when the money supply gets reduced in a particular area, what happens is the valuations all of a sudden start to look very, very attractive. And therefore, from investors' perspective, that particular space might start looking very, very juicy. Now, you cannot just go and invest in any companies based on the good valuations. You will also have to look at what is the headwinds the company is facing, what are the tailwinds the company is facing, and more importantly, what are the future growth prospects of a particular company. So in this video, let me bring this very, very practically to you by using 3 large cap companies as examples. And I'm going to run you through their headwinds, their tailwinds, and more importantly, what is likely to happen in these companies from a future growth perspective. These are not stock recommendations, but I can assure you, if you watch this video completely, you are going to gain ton of knowledge. If you're new to my channel, my name is Rahul Jain. Please do not yet subscribe to my channel. Watch this video for a few more minutes. And if you gain knowledge, if you learn something new, become my lifelong subscriber. With that, shall we get this video cracking? Let's go. The first company that I want to discuss with you is Tata Motors, a stock that was very, very popular in 2024. In fact, if you look at my screen, you will note that back in 2024, Tata Motors has soared to almost 1200 levels, and there was no stopping this bull until August-September timeframe when it started to correct. Now, what are the top 3 to 4 reasons that Tata Motor all of a sudden started to face problems? Let me give you 2 to 3 minutes unbiased commentary on that, and then I'll come to what the company is doing to turn around and to mitigate some of these challenges. So point number 1 is the JLR contribution, Jaguar Land Rover's contribution to this business. Have a look at my screen, and what you see here is that almost 71% of Tata Motors revenue in 2025 came from JLR, and almost 79% of PAT came from JLR. So JLR is extremely important for Tata Motors growth, and this company was showing a lot of growth until 2024. But what happened afterwards is, if you look at Q2 FY25, this JLR business division started to see problems. 10% reduction in the revenues, profit before tax tanked to almost 42%, negative cash flows. So because of these problems, all of a sudden Tata Motors stock started to correct. Now, although in Q3 and Q4, JLR's performance started to improve, by the time it started to improve, what happened was that Trump came into the picture and he announced tariffs. And if you remember, the initial tariffs on auto importing into US was almost like 25%. Only in the month of May, these 25% tariffs were reduced to like 10%. But as a result of this sudden shock, Tata Motors had to completely stop their US shipments in the month of April 2025. Now that is going to definitely damage their revenue and profitability coming from the US region, because for a month they did not do any shipments. They started resuming these shipments only in the month of May, June, but whole month they did not ship anything. And in terms of the money impact, their management came out and they said that if the tariffs were 27.5%, they would have lost around 1.6 billion US dollars. But since the tariffs came down to 10%, there is still an impact of around 600 million pounds. An obvious question comes that why is then Tata not setting up a factory in US? Company is saying that we have no plans to set up a factory in US because this is very, very short term, and this is also very, very unpredictable. On day 1, Trump is saying 27%, 50% tariffs, and all of a sudden he's reducing that to 10%. So you cannot really plan your business because of these changing tariff environments. But the problem for JLR remains their North American business, because if you look at this data here, you will note that North America is the highest volume generating business for JLR's business, and that is what has been hit very, very hard because of 10% tariffs. Also, what you see in this chart is that their China business has been continuously declining. And this is the second big problem that Tata Motors is facing even now. What is happening in Chinese market right now is that their premium market, overall market of China's EV sector, the luxury segment, has come down by almost 15%. This is a slide I've taken from Tata Motors investors presentation that came out in June 2025. Very, very recent data point. What company is saying is that the China market is also facing a big problem when it comes to the luxury segment. And the company themselves have recognized four big issues right now. One is the electric vehicle consumer transition that is happening. Second is the tariffs. I talked about that. Third is the new product investments that they have to put money into. And the fourth is the China market. But in addition to this, in India also, Tata Motor is facing very, very stiff competition. For example, if you look at the EV volume, in the last 3 years, if you look at the volume or the market share rather, it has come down from 87% to 55%. This is a big problem for Tata Motors right now. Can they sustain this market share is another question that investors are looking out for. Now, if you're an existing investor in Tata Motors or a new investor that want to invest in Tata Motors, you must be wondering how the future is going to unfold for Tata Motors. What are they really doing to mitigate some of these risks? So let me quickly walk you through what is the plan for future in terms of what Tata Motors is planning to do. Point number one is, if you look at their JLR story, they have four critical brands there. Number one is Range Rover, second is Defender, third is Discovery, and fourth is Jaguar. Now, these four models, if they can do something about these models and can turn around the JLR story in particular, then what is likely to happen is that they might come back to the growth path. For example, if let's say number one, what they're doing is Range Rover electric is what they're launching. Already 60,000 is the wait list. When is this going to come out in the market? I think late 2025 or early 2026. No date has been yet fixed, but this might give them another boost. Second one, in January 2025, they launched Defender Octa, a new model, and this model has been doing pretty well, but it's only been 6 months so far. So let's see how this model is going to perform in terms of the margins, in terms of the top line growth. So a lot depend on how this model is going to perform in the market. And thirdly, company has set up something called as China Resilience Project, meaning that they are trying to give customers in China luxury experience, and they're trying to get customers from China so that the Chinese degrowth that the company has seen can be put back onto the growth and they can maintain number one in the higher segments in Chinese market. Fourth and the final one, their Freelander model that was launched in 1997, they are relaunching this model in 2026. This looks very, very exciting to me. Again, we do not know how much of sales they are likely to generate, how much of margins they are likely to generate, but this again looks quite promising to me over the next 12 to 24 months. So in nutshell, they can't do much about tariffs, but they can improve their product portfolio so that they can start to gain the market share. But again, please do not look Tata Motors as a very, very short-term bet. Again, I am not a trader at all. I only talk about investments, 2 years, 3 years, at least 5 years, 10 years down the line, sort of a investment horizon. And you also need to know that the company is planning to put around $18 billion into JLR business between FY24 to FY28, and they're going to improve their engineering facilities, tooling, etc., and so on and so forth. So in my view, if you're looking at Tata Motors, please make sure that you're looking at mid to long-term horizon. Do not just look into the short-term headwinds that the company is facing. Of course, you need to evaluate what is happening. For example, what is the impact of April shipments that were put on hold into US? What is likely to be the impact of that in their revenues and profitability? It is likely to get reflected either in the Q1 of 26 or Q2 of 26. So in my view, next 2 quarters for Tata Motors are going to be very, very crucial. If you're an investor that is considering Tata Motors, in my view, have a look at what happens in Q1 and Q2 results. Look at some of the management commentaries, and if they're looking bullish, if they're looking bearish, and accordingly you make your decision. Do not just invest in a company just because of technical charts or, for that matter, corrections, price correction. You also have to look at the future prospect of a company. Also, if you look at FY26, in my view, the top line and the profitability in FY26 for Tata Motors is unlikely to be very, very high. The turnaround might be happening in FY27 and 28. Again, this is what the sense I get from their management commentary. So short-term pressure may prevail, but again, as an investor, you have to look at everything in terms of the future prospects, in terms of what is happening in the short term, and take your investment bet. Also, you need to look at what is happening in other Indian related stocks. For example, Mahindra & Mahindra, Maruti, Hyundai. These are all good listed players. You have to also compare and understand what is happening in that space. For example, very, very recently, I published this data about the auto sales that is happening in passenger vehicles, commercial vehicles sort of a space, and you need to compare which brand is doing better. It's not just you go and invest in one company. You have to look at where the competitive intensity is landing and where is the maximum value for your buck. Do not take any of these companies that I've spoken about as recommendations, but hopefully this gives you a view in terms of what is happening in Tata Motors as a company. And if you like this analysis, request you to hit the like button, be my subscriber. You can also join my YouTube community exclusively for content that I post almost on daily basis. For example, this post is only for exclusive members where they are almost on daily basis learning what is happening in the market so that they are well informed, they are able to take decisions based on some data. That is the most important part. The feedback of this community has been excellent. Simply go to my channel, click on join button and be my guest. With that, let's move to stock number 2. The second company that I want to discuss is ABB India Limited. Again, if you go back to 2024, have a look at my screen and you will know between July to October 2024, this stock had gone up to almost 9,000 rupees level. And after that, there was a huge correction in this particular company. I don't know when you're watching this video, please go and have a look at the current price. I cannot speak about the current price, but I know that the stock started to correct from 2024 level. Now, what was the reason for this correction? Let's try and understand. So if you look at the P&L statement of this company, you will quickly note that the company is sitting at all-time high sales of 12,268 crores, all-time high profits of 1,887 crores. So when a company is sitting at all-time high profit and top lines, why is that the stock started to correct? For that, if you look at these two data points here, that 3 years compounded sales growth has been around 21%, but trailing 12 months, if you see, the last 12 months, if you see, it's come down to 10%. And also if you look at the profit, 3 years profit growth was 63% yearly basis. It's come down to 29% yearly basis. What is it telling you? That the company is growing. Definitely it is growing, but the growth rate has come down. And when that happens, investors start to book profit. That is what may have happened in the case of ABB India Limited. But more importantly, if you look at what is right now happening with the business, so the company operates into 4 divisions: electrification, motion, process automation, and robotics. Again, I'm not going into details of this, but the point is that all of these 4 segments, they are capex heavy. If there is a lot of capex invested by either government or private players, the demand for the products into all these segments start to go up very, very quickly. In fact, right now, the capex injection into the economy has slowed down to an extent. For example, if you look at their order flows, what you will note here is the order backlog. Up until Q1 24, it was growing. You can see that growth path here. But after that, it has sort of flattened out. In fact, if you look at Q4 24, it has in fact dipped a little bit. And if you look at the order received, the order inflow, that has come down. Q4 24, the order inflows have come down. In fact, one of the investors in their latest con call asked this question that your order inflows has been very, very soft overall. What is really going on? And the company's management said that we have been growing at a CAGR of 22% in the last 5 years. So our base right now is very, very high because we are coming off the huge growth that we have seen in the last few years. And when the base is very, very high, the growth rate may look smaller. And also the next cycle of investment needs to come in to the Indian economy so that we can start to get benefited from there. And the second more important reason here is that the company caters to a lot of industries. For example, power, railways, data centers, and so on and so forth. They categorize these sectors into 3 categories. Number 1 is high growth, second is moderate, and third is low. And this is based on the demand that they are seeing from a particular sector. So if they are saying high demand from data center, they are classifying that into high. Now, what the company is saying is that if you look at the low segment here, low growth segment, the contribution by volume is around 45%. And this is where right now the capex has slowed down. So the moment the capex cycle picks it up into this low segment, which is all about power, cement, metal, mining, all that sector, then they are likely to see good order inflows. And when that happens, company is likely to go into the growth path again. Again, nobody can really predict when will that happen, but for investors, this is what you need to understand before you take any investment bets. Also, if you look at the PE ratio of this company, last 5 years, it used to trade median PE of around 103. Because of these constant corrections, the PE has come down to almost now 60 level, 65 level. Now, this is where investments will have to take their own decisions, whether they would like to invest in this company or not. Here, my intent was to give you this commentary so that you understand what is happening in this particular company. I hope you like this analysis. With that, let me go to the stock number 3 now. The third company that I want to discuss with you is REC Limited. I've spoken about REC Limited a lot on my channel. But what you note here is that back in July to almost October 2024 period, the stock was in a massive bull run. It was touching highs of almost 600, 650 and all that. And from that point onwards, it started to correct. Now, what is the reason for this correction? If you go and have a look at the P&L statement of this company, you will note that company is sitting at all-time high sales of around 56,000 crores trailing 12 month. And if you look at the net profits, 15,884 crores all-time high. When a company is delivering all-time high revenues and profits, why has the stock corrected? For that, we need to understand a couple of reasons. And in fact, before we understand the reasons, you need to understand the business model of REC. Very recently on my YouTube community, I had broken down the exact business model of REC Limited, giving a lot of details about what is their loan book, where are they giving these loans to, and what sort of NIMS margin they have, and a lot of other details which makes you understand what is really happening inside the company. And once you understand these business models, you're likely to appreciate what are the challenges the company is facing. If you're not yet a YouTube community member, please consider joining my YouTube community, because that's how you're going to learn about the businesses of these companies and you're likely to make well-informed decisions. But coming back to the challenges, right now, in my view, there are two main challenges that the company is facing. Reason number one is that company's guidance was reduced to 11 to 13% of AUM growth. Earlier, it was supposed to be around 15 to 17% of AUM growth. And right now it is projected to be around 11 to 13%. And when this happens, investors start to worry that if the AUM is likely to grow at a slower speed, then of course the PAT of this company might see an impact in terms of the growth rate. This might be one of the reasons. Second reason, more importantly, is that this company has seen higher early payments of the loans. What does that simply mean? This simply means that, for example, if you take a loan and if you take the loan at 9%, 6 months down the line, loan rates in the market starts to come down and it becomes 7%. Now what you can do is you can go and take another loan from somewhere else at 7% and you can go back and early pay your original, the first loan, because you can save in interest. That is what is happening in REC Limited as well. For example, there's a concept called RBPF, which means revolving bill payment facility. And in the last couple of quarters, this early payment by a lot of borrowers have seen a huge growth. It has gone up to around 22,000 crores, which is a good, decent money. And this is what worrying a lot of investors. They are saying that we are in a declining rate environment, as you can read here. And therefore, it is likely to happen that more and more borrowers may pay you early. This means that you might see some impact in your existing loan book. Again, the company is giving some mitigations, but this, in my view, remains a risk in REC. And that is one of the reasons the stock prices may be under pressure. Because of these headwinds, what typically happens is that you will see that PE ratio might come down. For example, in case of REC's, last 3 years, median PE has been around 6.7. And in 2024, it had gone to almost 11, 12 levels. It has now come down to the same median value, which is around between 6 to 7. So one could argue that the valuations have come down because of these fears. That's why the stock has corrected. Now again, I'm not saying that you go invest in REC. My point is very simple. You need to understand that these large caps are struggling right now, but could they recover? Next 2 years, 3 years, 4 years time horizon. That is something we need to understand. And as an investors, we might do our analysis, find out whether there is an opportunity or not. I leave it to you. This is not a stock recommendation video. Hopefully these insights have given you something new to learn about these three companies. And if you learned something new, like this video. Let me know in the comments a simple thank you. Subscribe to this channel because you're going to learn practically. Also, if you want to get exclusive content, consider joining my YouTube community. I post almost on daily basis and I break down complex financial concepts into easy to understand language that will make you good investor over a long period of time. With that, I hope to see you in my next video. Until then, keep rocking.